All right, Brian, we can't talk SaaS without talking customers. You're big on customer concentration and making sure that that's not the case for anything that you're buying. What's the picture with Manhattan Associates?
Yeah, concentration is definitely not an issue here. They have hundreds of individual customers, and their largest customers do not make up an outsized portion of revenue, so we can check that box. And when you think about what it takes to bring a customer into their business, that is a very expensive, very long process. They call out a 9+ month sales cycle. So just to get a yes. And then once they are chosen and implemented, that is a multi-month, if not multi-year process. So acquiring customers is very expensive for this business. On the flip side, once a customer is in their ecosystem, they are very dependable sources of revenue and going to become even more so as the company converts to the SaaS model. That's a major reason why we love when businesses go from licensing to SaaS. So I think that there's reasons to believe that Manhattan Associates does have good relations with its customers, and it could even in time boast pricing power because once they get in, it's so hard to switch over. That is something that I like to see as an investor.
And something else I kind of like to see is management's been with the company for quite some time. So you look at the people calling the shots. CEO Eddie Capel has been with the business for a good amount of time and seems to be pretty well liked there too.
Yeah, he started at this company in the year 2000 in the management team, worked his way up to take over the role as CEO in 2013. So he has been at this company a long time. If you check out his Glassdoor ratings, they're pretty good. 88% of employees approve of him as CEO. The business itself gets about 3.7 stars out of 5. So those are good, not stellar, but pretty good numbers. One knock I do have against this management team is that inside ownership is pretty low. CEO Capel owns about $10 million worth of stock, which is peanuts in compared to the grand scheme of things. But that is enough of an incentive for him to continue to see the share price move higher. So I would say pretty good management and culture, not the best we've seen, but by far not the worst.
Yeah, and to put that $10 million into context, I think they're currently trading at like $5.5 billion. I think that's roughly their valuation. So, this is definitely one of those companies that's kind of in that mid-cap sweet spot when it comes to SaaS. They are big enough to have a sizable business, not so big that it becomes really interesting for one of the tech giants to hop in there and say, you know what, I think we're going to get a piece of this too.
Yeah, totally.
All right, we're going to run through the red flags quick. I know listeners like your checklist, Brian. Want to make sure that we don't miss anything over there on the risks side as well.
Sure. There are, of course, numerous risks for investors to keep in mind, but this isn't a penny stock of any kind. As we touched upon before, there's no customer concentration to worry about. One of the things I like to ask is, does this industry face long-term headwinds or tailwinds? I believe the answer is tailwinds because retailers have huge pressure on them to invest in their omni-channel experience. One thing I will note is, one question I like to ask is, does this business rely on any outside force for success? And I think the answer there is sort of. They do sell a lot to retailers. That is their number one customer segment. So a healthy retail environment is important. If the retail sector in general took a big decline because of recession, you can see the case for retailers to make less investments into their business. So that is something for investors to keep an eye on here. And then finally, I like to look at stock-based compensation. Stock-based compensation is actually very low for this company, about $19 million all of last year, again, compared to a $5.5 billion market cap. So very, very small in the grand scheme of things. And this company actually produces so much free cash flow and so much net income that they've actually been a net buyer of their stock over the last couple of years. So the share count has actually declined by 13% in the last 5 years. That's something that investors should applaud.
Yeah, if you look at the share price appreciation too, it looks like a lot of those buybacks have been coming at pretty good valuations because the stock has just generally been up and to the right, particularly over the last year, but definitely over the last couple of years as well. And I think to mitigate one of those risks, you're talking about the dependency on retail, I do see that as a possibility. If you're running into several retail customers that are facing cash crunches, they may decide to, lower their investment in the space. But it's one of those things where long-term, if retail wants to thrive, they need to be making these investments. And so, I think that it's where the industry is going and they're in a good spot to take advantage of that.
Yeah, I totally agree. I mean, even some struggling retailers that we've seen, sometimes they do have pressure on them from investors to return to growth. And one way that they can do that is by really investing in their e-commerce capabilities and building out their omni-channel experience. That, again, pushes them into Manhattan Associates' hands. So there is a counter argument to be made that weakness in the retail environment would increase the pressure on them to make investments in themselves. So that could be a counterbalancing factor. But as for the stock itself, you mentioned that the share price has been fabulous performing this year. I mean, it's about doubled since the start of the year. So I think this is a very good, very dependable business that should just steadily crank out double-digit growth for the foreseeable future. But it is quite expensive right now. 55 times forward earnings and almost 10 times sales. I wouldn't be in a rush to buy this stock today, but I do think it is a stock that tech investors should put on their radar.
Yeah, I am definitely a fan of having a little post-it note with a couple stocks that I'm interested in, particularly if we see a bad day in the market and I can, start out a position, a small one at a price that I really like. But having that watch list is huge. And I think this is a company that absolutely deserves to be on people's watch lists.
Yeah, I totally agree with you. And we've seen a lot of our favorite high-flying tech stocks really get crushed over the last 6 weeks. This stock has actually held up very well, which I think is because the company is already profitable and trades at a moderate valuation in comparison. So if you want to get in on the SaaS conversion space, but you don't want to take on a huge amount of risk, this could be one to check out.
Thanks for putting another great stock on our radar and joining us today, Brian.
Anytime, Dylan.